Exactly how do banks create money? An explanation for the layperson. I'm assuming that you've heard that banks create money, but you find that hard to believe because how is that possible? In this video, I will show you exactly how it is done. But let me introduce myself. Why don't you just read this? I have been inspired by research that is written up in books like these. And what I have to say should be true in all modern economies. We all know that a bank intermediates money between savers and borrowers. For example, I borrowed 2 million kroner for an apartment. The bank takes the money from some account and transfers it to my account. I have to repay the loan with interest. The interest is compensation for the loss of liquid funds suffered by the lender. That's what everyone knows, right? But what does a bank really do? Let's listen to this gentleman who used to be head of the British bank regulator, the Financial Services Authority. In this book, he writes, read almost any economics or finance textbook, and it will describe how banks take money from savers and lend it to business borrowers. But as a description of what banks do in modern economies, this is dangerously fictitious because banks do not intermediate already existing money, but create credit, money, and purchasing power which did not previously exist. Let's see what two central banks say. The Deutsche Bundesbank, that's the German central bank, on their website, it reads, but how is this book money created? And book money is the German term Buchgeld for bank money. The banks create new book money when they grant loans. For example, Mr. Muller needs a loan to buy a car. He negotiates this with the bank's loan officer. The bank grants a loan to Mr. Muller. The loan amount is credited to his account and his credit balance increases. The bank has created new book money. It did this without needing to raise any savings deposits first. Here's from the Bank of England. In an article called Money Creation in the Modern Economy by 3 economists at the bank, the first bullet reads, this article explains how the majority of money in the modern economy is created by commercial banks making loans. Let's take a closer look at money. There are two kinds. One is cash. It's created by the central bank, but it only makes up a small part of the money supply in a country. What is the other kind? Well, you see it when you open your internet bank. You access it with your credit card. It's called money on account, that is, deposits in bank accounts. If you add the money that is in everybody's bank account in a given country, you get the rest of the money supply in that country. 100 years ago, the money supply in most countries was counted in the billions. Now it's in the trillions. When a country's money supply is expanded, that's called money creation. To create money is to expand the money supply. Now, where did that thousandfold increase over the past century come from? Who created that money? It was created through bank lending. To understand how, let's look at payments first. And let's be clear, payments do not create money, only loans do. But money creation is facilitated by the payment system, so we need to understand that. Cash is paid by hand, but banks do it smarter. 500 years ago, banks discovered that they could help their customers pay each other by book transfer, and so it is today. How does that work? I have an account in my bank for, let's say, 20,000 kroner. My younger daughter has an account in the same bank, saying the amount of 3,000 kroner. If Denmark only had 2 citizens, this would be the national money supply, 23,000 kroner. Now I want to pay her 5,000 kroner. When I do a few clicks in my online bank, that amount is subtracted from my account and added to hers. You notice the sum is unchanged. Denmark's money supply is still 23,000 kroner. Now say I want to buy a bike from the bike shop, which has an account with the Citizens Bank in the amount of 6,000 kroner. And let's ignore Alma's money for the moment. How do I pay the bike shop? How does my account money move to the bike shop's bank account? Well, there's a clever system for that involves the central bank. All banks have a so-called settlement account with the central bank, and each has some numbers in it. When I pay for the bike, 4 steps are involved. First, 5,000 kroner is subtracted from my account as before. Then my bank tells the central bank, subtract 5,000 kroner from our settlement account. In the third step, 5,000 kroner is added to the Citizen Bank's settlement account. Finally, that amount is added to the bike shop owner's account with his bank. The total money supply remains unchanged. It was 20 plus 6, now it is 15 plus 11. The pool of digits at the top is commonly referred to as bank's liquidity or reserves, or if you add banknotes in circulation, the monetary base. This total is also constant, 300,000, although it has been shuffled around a bit. The whole thing is called the two-tiered money system, 2 quite separate tiers or layers. One top layer involving banks and the central bank, but not consumers, and the other bottom layer involving the citizens or consumers and their banks. So payments, as we see, do not add to the money supply. They merely shuffle it around. Payments do not create money. But loans do. Let's see how. I still have my money in my deposit account, and the bike shop is here. And the money supply is 26,000 kroner. Now I want to buy some fancy electric bikes for the whole family, so I want to borrow 30,000 kroner from my bank. The bank approves my loan request, I sign a loan agreement, and the bank enters the amount in my deposit account. That's my loan, and my account now shows 50,000 kroner. Where did that 30,000 come from? Well, the bank opens a loan account in my name and enters the 30,000 kroner there with a minus in front. That is now my debt to the bank. I owe the bank 30,000 kroner plus loan interest, plus interest, which we will ignore for the moment. That's why the bank bothers to lend me the money in the first place, of course. Anyway, in bank language, the bank has extended its balance by 30,000 kroner and everything is hunky-dory. You will notice that the amount in my account has increased to 50,000 kroner. If you add that to the bike shop's 6,000, you will see that the money supply in this 2-person country has now expanded to 56,000 kroner. The bank has created money. It didn't exist before this amount of 30,000 kroner, but now it does. But wait, you might say, don't we somehow subtract the 30,000 kroner of debt that my loan account records? No, this debt accumulates in its own corner of the economy. It does not diminish the size of the money supply. We realize this when we take the next step. I took out the loan for a purpose, purchasing bikes for the whole family. I now want to spend the 30,000 kroner as a payment to the bike shop. This is done exactly as before, the 4 steps, using the central bank. So I now make a payment. Subtract the amount from my account, subtract it from the bank's settlement account, add it to the other bank's settlement account, add it to the shop owner's account with his bank. After this payment, the money supply is 20 plus 36, still 56,000 kroner. So you see, this payment did not increase the money supply, only the loan did. So two different things, the loan, which creates money, and the subsequent payment, which does not. Let's see what happens when I repay the loan. In the loan agreement, I agreed to repay the loan by 5,000 kroner every year the next 5 years, plus interest, but ignore that. This is money, the 5,000 kroner, that I must subtract from my deposit account and transfer to my loan account. Doing that, I reduce the national money supply. It was 56, now it is 15 plus 36 equals 51,000 kroner. Money is destroyed or retired from the economy. Repayment shrinks the money supply. Let's look at the settlement accounts at the top. What happened here as the loan was issued, spent, and repaid? Well, apart from some transactions, the sum of money here, the liquidity or reserves, remains constant at 300,000. It was 100 plus 200, now it is 70 plus 230. In other words, bank lending creates new money, and we're talking about the bottom tier or layer in the two-tiered money system. The amount of reserves in the top tier does not increase in this process. Let's go back and study the money creating process closer. You may argue that the 30,000 didn't come out of nowhere. It arose out of the debt I pledged to the bank. I promised the bank I will pay back the 30,000 plus interest. This promise, as laid down in the loan agreement, is an IOU. It is an asset to the bank, just as the proceeds of the loan, the 30,000 in my deposit account, is an asset to me, but a liability to the bank. In essence, the bank has purchased an IOU from me, that is to say, the loan agreement signed by me. The amount in this loan agreement has been recorded as the minus 30,000 in my loan account. The bank paid me for the IOU by entering the same amount into my deposit account. This is also an IOU from the bank to me. This amount I am free to spend 5 seconds later as a payment to someone. More technically, bankers and economists say that banks engage in maturity transformation. The bank has taken my long maturity, meaning that I will repay the loan over the next 6 years, and transformed it into a short maturity, meaning that I can use the money in 5 seconds. We may define a bank as an institution that does this very thing. It creates money for its customers to borrow and spend. This is the magic of banking. Customers don't have money now, but the bank will create it for them if the bank is confident that they will repay. Now, few bankers will admit that they create money. They will admit that the 30,000 entered into my account was merely subtracted from zero in my loan account. But this is essentially the same as creating money from nothing. However, bankers argue that when the money leaves the bank, when it is used by the borrower, me who's buying 5 bikes, then the bank suffers a loss. And this is correct. The bank has to part with money from its settlement account. It may have to compensate by acquiring funding. It may have to fund itself, as bankers put it, by borrowing from other banks. Well, yes, this is true, but bankers usually forget to add that all the other banks are also engaged in payments and lending, so that later in the day, a similar amount will flow back into my bank's settlement account. By and large, amounts outgoing from one bank's settlement account is matched by similar amounts incoming. And when they don't match up, banks borrow the marginal amounts from each other as overnight loans at microscopic interest rates. No problem at all. Normally, the two-tiered money system is humming along nicely. Payments deriving from loans blend in with regular payments. That is, new money mixes with old. No one notices the difference. It all looks like old money. So the whole payment system or the clearing system allows freshly created money to be used by customers in other banks. The payment system enables money creation by banks. You may be wondering about the debts incurred by me and a million other borrowers. Are they not subtracted from the money supply somehow? No, as I suggested earlier, debt is just accumulated in the bank and the general economy. We can have lots of money and lots of debt at the same time. As I showed, every new bank loan creates a corresponding debt, the borrower's debt to the bank. This way, the money supply and the sum of private debt rise together. This is why people sometimes say that money is debt. They should say, in the present system, money is created out of debt. So how can the money supply grow as it normally does in most countries? Well, when more money is created in one year than is repaid for loans taken out in previous years, the money supply grows. More money into the bathtub than out. This means that the water level rises, the total amount of money in circulation, the money supply. This is why the money supply in practically all countries is now counted in the trillions, not merely the billions like 100 years ago. That corresponds to a doubling of the money supply every 10 years on an annual growth rate of about 7%, typical of many countries. Now, you may ask, can banks create all the money they like? Is the sky the limit? No, there are many constraints. A bank must have sufficient liquidity or money in its settlement account so that it can handle the payments that its customers want to make every day. The central bank may impose such reserve requirements. There are capital requirements, meaning that a bank must have money of its own, usually corresponding to 5 or 10% of their loans outstanding. Then there is macroprudential regulation, meant to ensure that banks act with prudence in the interests of society. Every individual loan applicant must be evaluated as creditworthy by the bank, and many applicants fall by the wayside. Banks don't create money for fun, because if the loan isn't repaid, the amount gets deducted from the bank's equity, its capital. For a bank to produce money, there must be willing borrowers, which also puts a limit on lending or money creation. Despite these and many other limitations on the creation of money by banks, the money supply in most countries expand by several percent, maybe 5 or 10% annually. In Denmark, the expansion was 140 billion kroner in 2020, about 10%, as is shown in the bottom row of this table. So to sum up, we see that the bank does not lend savers money to borrowers. This was true in the olden days when a saver would deposit a bag of gold coins with the bank, and the banker could open this bag and lend some of the unused cash to borrowers for them to use. But today it's all done with numbers in accounts. These numbers represent purchasing power, credit, and money. They are money. You pay taxes by transferring some of these digits out of your account to the tax authorities, and that is the ultimate proof of what constitutes money. The key point is here, bankers control these numbers. They can lend money by entering digits into your account and deduct it from nothing, creating money in the process, so long as they trust you will repay and under various other constraints. They don't need to access other people's savings. Banks create money through the process of lending, not by intermediation from savers to borrowers. That said, a bank must have deposits. Deposits usually enter the bank by transfer from other banks, which means that the bank's settlement account gets filled up, so it is not depleted through outgoing payments. Deposits are not trivial. Banks need deposits, but they just don't lend them out. Deposits are in the bottom layer, and when banks lend, only numbers from the top layer are subtracted. That's how that's how bankers do not lend a particular saver's money to borrowers. Money is first created in the borrower's account and then subtracted out of this pool of digits in the top layer in the settlement account. All of this is accomplished by the shrewd clearing system of settlement accounts. This system was many hundreds of years in the making. It was pioneered by the Bank of England in the middle of the 1800s. This is a picture from the New York Clearing House in the late 1800s. This system is now found in every country in the world that has money in any modern form. It is often called the payments and settlement system. It facilitates money creation, but don't expect banks to admit to this. As banks see it, the payment system is just a great service to customers. It's not an intricate machine for creating money that customers borrow at interest. This interest being the supreme benefit of money creation that is reaped by the world's bank owners. This concludes our tour of the payment system and how money is created by banks. Here are some references to money creation in general terms, and here is some specific literature on clearing systems. Thank you for your attention.